We have an exciting video today. It is all about 3 easy ways to boost your returns as a retail trader. And I teach a course on options trading. I'm an options mentor. If you're interested in learning from me, you can click down in the description. There's a link there where you can schedule a meeting to learn more about how to work with me in a group setting. It's a really great group, and I'm super proud of the work that we do there. But one of the things that happens when I am talking to retail traders, and I talk to about 8 of them a week and interview them and see if they'd be a good fit for the program or not, is I ask them a bunch of questions. And through asking these questions, I can easily identify what sorts of areas they need improvement in and how I could help. So I'm just going to identify 3 of those problems, really simple problems that people have, and how to fix them in this video. All right, so we can get started here. So we're going to review the top 3 easy fixes traders can make to harvest extra percentages per month into their account. So this is what it's all about, guys. Like, if you are looking for an options mentor, it's probably because you know you're underperforming in some kind of way, or you know you could just do a little bit better than you're doing right now. A lot of people also want consistency. So if that's you, there are simple, easy fixes to just make an adjustment here or there that can really get you more money per month. So if you're used to getting about 3.5% returns per month on your options account, have you ever looked into what 5 years of compounding would be if you got 4.5% instead? It's kind of insane, the results there. The compounding is like, what is it, the 9th wonder of the world or something like that. So it really does make all the difference, and it's worth the effort that you put into it. Okay, so there are 3 problem areas that I see traders working with that I want to course correct for them. And one is problems with the cash secured puts. Number 2 is not cutting losses sooner. And number 3 is not trading with seasonality. Okay. So how do I know this will work? Just fixing these things. So I talk to about 8 retail traders a week, and I've done this for 2 years. People that join my program that are traders usually double or make a 30% increase in the amount of money they make within the first month or 2. It's a pretty incredible result. So when I meet them, I dig right in and ask questions about their trading habits and their knowledge. And by getting just about 5 to 6 questions answered, I already know what they're struggling with and why the results aren't where they want them to be. And also just like what's keeping that dream of making a significant income out of options or turn it into their lifestyle, like a distant dream instead of a reality that's going to happen sooner than later. Okay. Most people think that they can trade with the wheel and that will make their dreams come true. And it may do if you have a $3 million account. But when we have less money than that, we simply need to know more. That's it. It's as simple as that. We just simply need to have a better education and know how to employ more of these trades. So again, how do I know how this will work? Is because I've taught over 150 people how to trade options in the last 2 years. And about 3 to 6 more people join my group every week. The success stories have really started to pile up, but I really like this quote from one of my members who joined in June, who had traded options for years with inconsistent results that he wasn't terribly proud of. He was doing okay, but he just knew that he was missing something. Okay. So I'm going to share the quote in just a second. It's because we get results from simple changes. That's really what we do here. So this is one of my traders, and he said, hey, Erica, I will tell you this. Since using some of your methods, I'm looking on 4 digits profits per month. And honestly, it's pretty easy. This is always what we say to some people. It's so easy. It really is easy. You just have to follow the rules and the strategies you provide in the course. I haven't done any spreads yet, but I'm working with mainly covered calls, cash secured puts, and leaps. Leaps is putting him kind of over the edge here of what he was doing previously. He's also learned to manage covered calls and cash secured puts better. Going back to his quote though, I couldn't really do spreads in my Fidelity IRA, but I'm going to start soon with Robinhood. I'm just letting the profit remain in my accounts and growing them as I don't need the money right now. I'm so glad I took a chance with you. I made the course cost back in the first month and a half, which he paid 5K for. And he was being very conservative. So I'm excited about thinking about where I will be in a year. So again, this result isn't uncommon in my group. I check on everybody about the 3-month mark. This is when I checked on this guy, and this is what he had to say. So again, he's just doing so much better than he used to be doing. So the 3 fixes, and some of the fixes that he was making, is that we want to take the cash secured put and we want to turn it into a covered call. We're trading cash puts far too often. We're not trading covered calls enough as retail traders. I will show you how that is true in just a moment. Number 2, we're holding on to stocks that are in losing positions or are just holding back us from getting gains, and we're just not cutting our losses sooner and moving on to better pastures, greener pastures. And number 3, we're not trading with seasonality, and we need to learn how to trade with those seasonal patterns and know what's coming next with a good degree of certainty. Okay, it won't always work, but it works like 80-90% of the time. And if you are a trader, you know those options are pretty darn good. Okay, so number 1, we are going to stop trading the cash secured put as our main trade that we trade. Okay, one simple mistake traders are making that is costing them thousands per year is a preference for one trade versus another, and the trade that they prefer is the cash secured put. It just became popular with retail traders. Probably there was somebody who was sort of like a famous YouTuber or something like that that started saying this, and then a lot of times what ends up happening as you see other people just sort of copying content, and it just becomes like parrots singing the same song or saying the same word over and over and over again. And that becomes what everyone tends to learn. There's also reasons to love it. And these reasons are very intoxicating. So let's go into that. So why do they love it? Why do retail traders love the cash secured put? Okay, it seems so glorious. The idea of milking money from the market without putting any money in a lot of the time if you don't get assigned. And to boot, if we do get the shares assigned to us, our view is that we got the shares on sale. So that's like quite an intoxicating deal, is it not? This combination platter, it just is like such a good combo meal, lures us into the false sense that this trade is the best, but it's not. Okay, it's not. It sounds so good. It sounds so good that it sounds like it might be the best. But it's not, and we're going to go into that and just why that is in just a moment. Okay, so we're sort of reviewing again here why these traders prefer the cash secured put. And the first reason is they've been told it's the best by other YouTubers. Okay, the second is they've been taught it's the first step to entering the wheel, but this is also false. It's not true. Like, you can enter the wheel with the covered call first. There's no reason why you can't. Okay, and number 3, it appeals to a certain mindset. And I really do think that's the main reason that people get into it. It appeals to a certain mindset. So what mindset does it appeal to? A middle class mindset, okay? And there's nothing wrong with being middle class or working class. I was raised in a middle class lifestyle as well, but it has its faults being raised in a middle class or working class mindset or environment, because we have all of these sets of values that were instilled upon us, that we try to use those values and apply them to every puzzle or every problem that we face, when that set of values doesn't even solve every equation. Okay, we're raised to look for deals and get things on sale whenever we can, as you know, working class people or middle class people. Like, that's smart. It makes a lot of sense because pennies can make a big difference, as those popular sayings go. I think in French, my husband's family say like pennies become rivers or something like that. So, I mean, those things are very wise. Yes, if you try to save money on laundry detergent, that's a great idea. I'm not going to argue that it isn't a good idea to do so. Like, if you can get it somewhere cheaper, get it somewhere cheaper. The problem is that when we take a middle class savings mindset into options trading, okay, it doesn't work there the same way. It's the wrong mindset to take into trading. We aren't trading alongside other middle class people for the most part. We're trading amongst the ultra rich. They have access to cash that you and I can't even fathom. Like sometimes I'm just like, oh my gosh, somebody just bought 10 million shares of Apple. Like it's insane with the money that they have access to. They don't wait to get things on sale. They act all of the time because opportunities are always there for them and they see those opportunities. Again, they are not waiting for sales. So I'm mentioning this only because I want you to see what you are missing. Okay. And what you're missing is so simple. What you're missing is that you're missing the covered call. That's it. Okay. So don't take my word for it. Take this woman's word for it. See what I mean? Okay. So here we are. We're with another one of my course members that joined in June. And now I checked in on her and she got back to me on August 6th and said, yes, the program is helping. I listened into the recording of each class session. So she comes to every Tuesday meeting that we have as part of our course. My results are good in June, $17,464 in premiums and cap gains altogether. Okay, do you guys understand she can't make those cap gains if she sells cash secured puts? It's impossible. It's impossible, and it's a big part of her number when I checked back in with her. Okay, she also didn't roll or buy back her covered calls as she did before she talked to me and started with the program. So she made really good income that month instead of the losses that she hadn't made. So again, she came into the program, she was up some months, down some months, losing money. She doesn't lose money anymore. She makes money because she turned around her thinking about some things. So these fixes are very easy to make. And I'm telling you, the covered call, just doing the covered call over the cash secured put is one of those. Okay, so this is her take on it. But let's go into something more on this. I'm just going to prove it to you with some math, okay? Number one reason that the covered call is better is because in the covered call, you can make capital gains, okay? You chose the stock that you are trading because you think it's going to rise, right? Okay, if you didn't, we've got another problem on our hands. But I'm assuming that's the case, okay? So if you chose that stock because you know that it's going to rise or you think it's going to rise, then why don't you want to put a piece of that upward movement into your pocket and collect it? The covered call gets cap gains and the cash secured put does not. This is just a simple fact that is simply too often overlooked, and it makes huge amounts of money, okay? So let's dig into this even more. So how often is the chart moving up on your favorite stock? You better say 75% of the time, or I'm going to question your stock pick. But go look at the 5-year chart, okay? And let's say you picked a stock that's going up 75 to 80% of the time. So if you do the opposite of what you should do here by selling a cash secured put that has a 20 delta, that means you've got, like, in your mind, you've got a 20, even though it's not correct, but I'm going to use an example of what people are thinking out there. You're selling a cash secured put with a 20 delta and you think you've got a 20% chance of assignment. So you're rarely getting assigned, right? So then when you do get assigned, you're selling a covered call and maybe you can make a cap gain there, but you're rarely getting assigned. So your stock is simply rising with your strategy and you're getting 0 cap gains out of that rise. That doesn't make any sense. Like, step back and think about it for a second. That's what I'm inviting you to do right now. If you went ahead and bought the shares and sold a 55 delta to capture a $150 cap gain on every trade, you'd be in a totally different world a year from now, right? What do I mean? Okay, so what are you missing? You're missing the covered call. Okay, so let's do a covered call example. So let's say we buy, this should say 100, not $100, but 100 NVIDIA shares at $177.50. Selling the 180 strike price for a 3-week call is $450 in premium. And if we get a called away, we get approximately another $250 in cap gains. So we make $700. Sweet. That is such a great deal. Okay. So let's expand the example. Over a year, let's say we get called away half the time and the other half of the time we keep our shares. So there are 7 time periods of 3 weeks in a year. Okay. And if 8 of those times out of the 17, we are making $700, that is $5,600 that we're making. And if 9 of those times we're only getting the premium, we're making 450 times 9, which is $4,050. So the total that we'd make that year is $9,650. Now, guys, this is hypothetical. I know you're going to be like, in the comments, like, it might not work like that. I know it might not. But let's compare it to the same example in the cash secured put. Okay. The cash secured put premium for a 3-week option that is $2.50 down from the current stock price is $400 in premium. So you're already getting paid less premium. And 17 times 400, because there's 17 3-week time periods in a year, is $6,800. I don't know about you, but I'm going to take $9,560 over $6,800. Do you guys see how this is like $3,000 more? Now imagine you have 5 lots of this in your account. Where are you now? You're in like a totally different place, aren't you? Financially, at the end of the year, you are. Reason number 2 that the covered call is better than the cash secured put. The second reason is that we can collect dividends when we own shares. Okay? It's just as simple as that. Okay? So the dividend on NVIDIA, the stock that we just looked at, is not much to mention. But when you're trading stocks like Apple, the difference can be significant as the years add up. Did you guys just hear my dog like shaking her collar? She had an itch. Okay. Over a year, the dividend on Apple is $1.04 a share, or 26 cents per quarter. And if you're trading Apple all year long, you'll collect $104 per lot of 100 shares. And when you're trading 500 shares of Apple, it adds up over the years. Also, dividends benefit from a lower tax rate, so this is income that we want to get, okay? And I know this doesn't seem like a ton of money, but again, when you're adding up these little like percentages to your returns as the years go by and by, it does add up. You just can't say it doesn't. So reminder that when you trade cash secured puts and you think it's great to get shares on sale, you're missing out on cap gains and dividends. So are you really doing yourself any favors? I would say you're not. So put away your middle class mindset and start thinking wealthy. This is one of the things you're going to have to do is you're going to have to start thinking like you're wealthy, okay? And these are the kinds of decisions that wealthy people would make. In fact, did you know that there's so many wealthy people that just live primarily off of dividends? Crazy but true. And have had shares for like generations. Wow, incredible. Okay, so the second thing that I see people making mistakes about is that they don't cut their losses sooner. So I go on and on about choosing the best stocks, and choosing the best stocks is great. You have to do that, but you also have to know when to cut your losses when that great stock pick falls out of favor and is no longer great. It's just kind of good. Okay. So this happens. Nobody will be immune to this. You can make a great stock pick and then the stock can change. The story of the stock can change. What's trending can change. All sorts of things the world can change. Okay. So I'm going to assume for the purposes of this video that you've already chosen a stock with a rising 5-year, 1-year, and 3-month chart, because if you haven't and you just make this simple change, your profits will soar. Okay. So that's a tip for you. Like if you haven't just made that adjustment, your profits will soar. But let's just say you followed those rules. And if you've chosen the best stocks, the next step is to cut your losers and start cutting them sooner. Now, this doesn't mean that you need to go out like today and start cutting stocks. They could all be working beautifully for you. But you'll start to notice when one is not. And then that's kind of when you need to pull the plug. So we all have stocks in our portfolios that are not doing as well as we had hoped. Often we hang on to these because they're only down 10% when the market is moving up, and we think, hey, they'll catch up. Like, they'll catch up. It's going to be all right. I wasn't an idiot choosing this stock. And I just want to say, like, you're never really an idiot for choosing a great stock and for it to be stuck. You're kind of only an idiot if you just hold on forever. Okay. So that's the distinction there. Okay. So, but then what happens when the stock slides 10% is that it might slide another 5%, and we just end up making more excuses for it. And then we go like, oh, it's only another 5%. It'll turn around. And before you know it, the market has jumped like another 5% and our stock is still stuck. I mean, it's a tale as old as time. I know that people run into this quite frequently. So stocks can get stuck for a few reasons, and I think it's really important to understand the reasons they get stuck and see why your stock is stuck, and then make a decision from there. And when we say stuck, I mean it could also be declining, right? Um, which would also be bad. But we need to kind of diagnose what the problem is, and then we need to make a decision based on how are we going to treat the patient once we have the diagnosis. Okay, so the first problem can be that earnings and revenues have gone down in the stock. The second is that the stock is falling out of trend. The third is that institutions started to prefer other stocks to trade instead of this one. And number four is the stock is in a consolidation time frame. So there might be more reasons in this, but these are the top four reasons that I tend to come across. Okay, so number one, if earnings and revenue go down, you gotta go through and evaluate what this means. Okay, so earnings and revenue being down on a quarter is a bad sign. Now, if you just have a stock that's missing one area of their revenue, like they had a little miss on the cloud because it's Microsoft, but they're making money in all these other sorts of areas, that's not a real miss. It's a miss if their overall revenue was a miss from the previous quarter. Okay, so be really pay attention to the details here. Follow every stock that you're trading and be in the know about how they do every earnings period. And if there's a slump, read why. So I love Yahoo Finance for this. When my stocks have earnings, I'll go in and read them the day after, and I'll read about what the earnings said. If it's all cool, then I'm just like, ooh, okay, awesome. If it's there's some sort of bad news there, I read the story and try to understand the story of what happened, because it'll give me a good indication if this is a problem they can easily get out of or not, and how much of their revenue is tied to this problem, and how they could get in or out of it. Okay, so if it sounds bad, you got to get out. The thing is institutions will notice that this happened to the stock and they will leave. So why should we stay? Because you have to think, when they leave, they're taking our money with them. Because when they leave with their 10 million shares, what ends up happening is that the algorithms see that they left with their 10 million shares and they start selling as well. And then guess who's holding the bag? Us, because we're not paying attention. So they look at information like this. We don't. We're kind of lazy. So I'm just saying, hey, let's not be as lazy. Let's be smart like them and look at this stuff. And then we can just go when they go. All right. So this is one of those things, though, when the earnings and revenues go down, there are some exceptions to the general rule. Okay. So if a stock has a great fourth quarter because they have holiday revenue, like Apple, Amazon, Costco, something like that, the first quarter could be down in the next year from the previous year's fourth quarter. And that's no cause for alarm, because they have a super high earnings fourth quarter because of the holidays. Okay. There's other instances like this in the market. A lot of times Home Depot and Lowe's have a really killer spring quarter because everyone's going out to buy stuff for their garden. And then their summer quarter might be down. But you've got to read, you got to understand your stocks and read the story to understand it. I always love this because there's a dip in Costco in January because in the first quarter, because the first quarter revenue isn't as strong, and it's always just a little thing where I go in and buy shares because it's almost like a mistake that happens in the market, because there's nothing wrong there. It's actually perfect. It's working exactly the way that's supposed to. So I get a little dip on Costco, I buy shares and the shares go up. So there's ways to take advantage of that as well. All right. So number two, the stock falls out of trend. Okay. So stocks fall out of trend because what they sell is no longer in demand. People don't want to pay money for it anymore. Nike is a great example of this. They were the athletic brand for decades. And in the past few years, though, other brands have snuck in to eat their market share. The trends changed, okay, with athleisure and sportswear. Women now care about this premium fabrics, the buttery soft fabrics now. It's like a debate, for me, because I buy these leggings all the time to go to the gym on, and it's oh, Lululemon, oh no, now this other brand has an even softer material, and you're just it ends up feeling like you're not wearing anything at all. How great these fabrics are. But that's like the appeal that these brands are pulling women in now with, and men are demanding better quality and putting less importance on the name brand and just sort of more importance on the comfort or things like the weight of a material, for example. So Nike doesn't simply have this brand appeal to it anymore. And that's a reason to leave. Okay. I read about Nike when they started to go down, and they actually said on their own earnings call that they're experiencing increased competition. And I was like, wow, that's the kiss of death right there. They're admitting it themselves that they're having increased competition. I was almost surprised they were saying that on their call, but they were openly admitting that they were once a dominator and now they are just one of many sports apparel companies. So I don't want to be catching falling knives, which is why I actually got out of Nike. I was trading Nike a lot before that. So he's like trading about 200 shares cover calls on Nike. And then I had to pull the plug on it. It's just what we have to do. All right. So this is actually number 3, but institutions stop trading the stock. That's another reason that we need to cut our losses. So this one sucks. Okay, so you can trade a stock that is trading like a dream and the earnings and revenue are looking great, and then the stock stops moving because the institutions simply stop trading it. They were like, I don't think I'm going to trade this anymore. I'm going to go move to another stock. And so this happened a lot during the AI craze, which is still going on. But in recent years, they moved their cash into AI stocks and pulled them out of non-AI stocks. The AI stocks got all the love and all the money and left previously successful stocks behind. So these stocks, I'm talking about something like a Pinterest. Pinterest is really interesting for this. So it was doing fantastically well during COVID. After COVID, made some adjustments. It's like its numbers are better than ever, but it's not going back up because the institutions just decided they're not going to trade it anymore because they would rather trade other stocks. Which stocks do they want to trade? AI stocks and tech stocks, because they're a greener pasture, and that's where they went. So when this happens, you simply have to admit it when it happens. And if you're smart, you go where they went. That's what I did. I was like, okay, they're not in Pinterest anymore. I'm going to go over where they're going. All right. So how do you know where they went? That's the question. Is like, okay, I know I've got to leave here because the stock is going down. That's how you know that the gig is up on this stock. Okay. Well, how do you know where to go? You just look at which stocks went up a lot during the last year at a good clip. The only force that can make that happen is an influx of institutional money. It's as simple as that. So you know where to go. Do you know when to leave? You got to leave. You just got to leave. Okay. The fourth thing that can happen is that the stock is consolidating. So consolidation is tricky. It's hard to know when you should leave or if you should stick around. Here, when a stock is consolidating, the earnings are great, the charts are great, but every great stock has a 6-month to a year consolidation time period every 4 to 5 years, generally speaking. Okay, so NVIDIA had a consolidation last year. I'm making this video in September 2025. So in the last year, it had been consolidating until about 3 months ago. Okay. It was on a historic tear for 4 to 5 years. And last year it went into dips and didn't really break out into new highs. So it was classic consolidation thing. Okay. With NVIDIA now out of its consolidation pattern, like I'm coming back into NVIDIA because I can see that now it's making breakout. Okay. So here's a tip for you though on consolidation. Stocks often consolidate right after stock picks, not before, right after. That's a really classic time. Microsoft consolidated last year. Did you notice that? Didn't do anything. Had 5 epic years before that. Now it's taking off again. Okay. So this year, I believe what I'm seeing is my beloved Costco in consolidation mode, which makes me sad because I'm used to make about $50K a year on just repeating the same 10K leaps purchase and selling it when it would double like clockwork. And this year, that trade just simply isn't available to me because Costco is consolidating. It sucks, but it's a reality, and I know that. So I'm not doubling down on Costco and my leaps. I'm just sort of accepting it and moving over to somewhere else that is moving, like Nvidia. You see how I can just roll into something and then roll out? That's what you got to do. That's what you got to do if you want to keep making money. So I moved out of my Costco leaps, and I'm on my first losing Costco leap this year. Okay. So I'm not so much in the leaps anymore because I have one like sort of losing position that I'm still wondering what I should do with, but I've kept my shares and I'm simply selling covered calls on the shares for now. And I'm happy with that decision. Okay. I'm glad I didn't sell my shares. Okay. You could sell your shares though here. There's nothing wrong with that if it's consolidating. Sometimes it's a good move to sell the shares when they're in consolidation a year and then simply move back in when you're done. That's what I did with Nvidia. So you're probably wondering, why did you do something for Costco and not the same thing with Nvidia? And the reason was because it was just an allocation in my portfolio that I was comfortable with. So you have to make sort of those decisions for yourself, okay? So you have two choices on a consolidating stock. Stay patient and wait, keep selling covered calls, or sell and move into one that's moving. Remember, you can always come back later into the stock once it starts moving again. You'll see when it stops consolidating. You can put an alert on your phone. Hey, when this stock starts to break out past its previous all-time high, I want to know about it. Or when it gets to 10%, close to 10%, to where its all-time high was, I want to know that. And you can set an alert for that. Okay. So cut your losses sooner. What's the solution to this? There are reasons to stay stock. Okay. Consolidation is the only one I would stick around for. And I do it with a limited portfolio amount as well. But the way that I do this is I make hard and fast rules for when I'll sell a stock before the decline happens, so that I'm not making these choices when I'm in the emotional state of, oh my gosh, the stock is going down. And I don't get stuck in that, like, oh, it went 10%, it went 5%, it went 5%. And now all of a sudden I'm at 30%. And I'm like, dang, I'm in a position right now I don't want to be in. So for me, my rules are 2 bad earnings calls and I'm out of a stock. Like 2 disappointments, I'm done in a year. Okay. 3 to 6 months of declining stock price when the market is moving up, and I'm out. So I moved out of my Costco leaps and making consistent plays with Costco leaps because I noticed that the stock was consolidating. And that was one way I pulled back on trading that stock. But I kept my shares. And I kept them because I was really comfortable selling covered calls on those shares. Like the premiums are quite large, and I have owned these shares for a long period of time. And I do have a significant amount of cap gains built up in them because I've been acquiring them over a certain period of time. And I don't want to pay cap gains tax on them. Okay, that's a decent reason as to why. And I also know that nothing has changed within Costco. It's still a great company. It's still got great earnings and revenue. It's still going to blow it out of the water at Christmas time. Like, there's things that I know, especially it pays a special dividend here and there of like $10 a share sometimes right after the holidays. Not every year, but the years it does, it's incredible. Okay. So sometimes it's a good move to sell shares when you're in a consolidation year and then move back into share ownership when the stock takes off again. That's what I did with Nvidia. So you're probably sitting here wondering, like, why did you stop trading Nvidia, but you didn't stop trading Costco? And I'm like, that's because I was comfortable with a certain amount of my portfolio consolidating at the same time, but I didn't want too many consolidators at the same time. Okay. So that's why I made the decision. So you really have 2 choices with the consolidating stock: stay patient and wait, or sell and move into one that's moving. Remember, you can always come back later to that stock. It's not like when I said goodbye to Nvidia, I was like, oh my gosh, this is goodbye forever, Nvidia. No, I just set a little alert on my phone saying like, hey, when this starts hitting 140 again, stock alarm, let me know. Like, you can send yourself an alert for that. I actually don't need an alert because I watch the market every day. But let's say you didn't. That's an idea on how you can handle that. Okay. So there are reasons that stocks stay stuck, and consolidation is the only one that I would stick around for out of that list of 4. Okay. And I do it with a limited portfolio amount, as I just reviewed with you. Like, I'm only happy with or satiated, I would say, with a certain amount of my portfolio in a consolidation mode at the same point in time. Okay. So, what is the solution for this? Like, how do you avoid this situation where you can sell at the right time or a better time than you have in the past? Is you have to make hard and fast rules for when you'll sell a stock before the decline in the stock happens. And so I would really invite you to do that today. Put it on your to-do list for tomorrow, okay? Like, do it soon, okay? So I make hard and fast rules for this so that I don't have to make the decision in the heat of the moment when the stock is falling and like get tricked into just waiting another day and allowing that stock to fall further, okay? So for me, 2 bad earnings calls and I'm out. In fact, after 1 bad earnings call in a year, and I'm talking about a year here, I'm on high alert. Like, I'm reading the news about that stock, like, and if I see something is like not looking good, I'll get out before the second bad earnings call. Like, I'm following that story as to why they didn't do well. And I'm looking for more clues or more of the story to emerge to see if that looks positive or negative for the stock. If I start to hear more negative news, I sell. Okay. And then 3 to 6 months of a declining stock price when the market is moving up, and I'm out as well. Just like, I just don't have time for that. That's not something I have time for. Okay. So you have to figure out your exit plan in advance so that slow 5% drops that we talked about earlier, where you drop 5 and then 7 and then go up 2 and then drop another 5, don't trick you into prolonging your losses and allowing those losses to get deeper. Okay, so that is number 2. Oh my gosh, it's a long video, guys, but it's so important. Okay, number 3, the third thing that you can use to get more premium out of your account is that you can learn seasonality. Okay, there is a yearly pattern to the stock market. August is rarely a bullish month. November and December are usually glorious if you like to see your portfolio grow. Every month has a pattern that is likely to have happen with 80% accuracy. Some pretty crazy odds there. Sometimes the incoming month may be simply known to be choppy, but knowing it's likely to be choppy before it happens is a huge advantage that you can take advantage of to match trades to. So in my trading group, I mentor how to trade with the coming month in mind so that you can prepare your portfolio to take advantage of what's coming. Okay, that's how you get good at seasonality. That's how you get the extra percentages out of it, is to go like, okay, this is what the market is like right now. And I kind of knew it was going to be this way. And then next month, it's probably going to look like this. So I'm going to prepare my portfolio to trade that. I'm going to set up trades now that expire then, that take advantage of the thing I think is going to happen. That's how you make a lot of money, okay? Training yourself to think a month ahead and plan your moves further out in time is a skill that will pay off handsomely. It's also a mindset game. Why is it a mindset game? Oftentimes we're in a month that is absolutely stellar, and I have to tell my group that a bearish month is coming. Guys, I know your portfolios are at all-time highs. Take a picture, smile next to it, because we're going down. And I'm such a bummer. I'm such a buzzkill, but I'm also right. Okay. So now I follow seasonality and it's led to higher yearly returns. So like, how is this a mind game? Okay. Imagine me telling you, hey guys, your portfolio is all at all-time highs. But next month we're going to have a bearish month. So I want you to set up a bunch of trades that are going to take advantage of this bearish month, or that might be a smart thing to do. Or like, look at these trades you could pair potentially with this. And when I talk about a trade, I'm not saying like, take this trade. I'm saying you could set up bearish trades. And here are some bearish trades you could choose from as strategies. That's what we're talking about. Okay. And so you have to sit there and go like, oh, I'm going to trade bearishly right now with the expiration dates, even though my portfolio is soaring right now. It's like, woo! Like you're like almost a little bit bipolar in that moment. Okay. So that is what I'm talking about. This leads to highly yearly returns and higher monthly returns as well. So there are some people that are going to argue that seasonality is not real. And I would simply say it's real for the best stocks. For the not best stocks, you're right. It's not that real. They don't trade with seasonality. Trade with the best stocks though, and see what changes. I really challenge you to do that. Okay, so people would be like, I back tested it. And I'm like, what did you back test? And they never have an answer. Okay, one last thing on seasonality. Stocks also have their own unique seasonality too. There are stocks that have amazing spring season. Home Depot and Lowe's are two of those. Semiconductor stocks like Nvidia have really mild Aprils and Septembers. It's just the way it goes. And so if you know that that's the way it goes, wouldn't you trade that? It's kind of a no-brainer, right? So know these patterns, know your stock picks, and trade with those movements. Reap the rewards for studying up on seasonality. It's like really as simple as that. So these 3 simple changes that I introduced you here in this video will make all the difference in your upping your percentages. Again, they are trade the covered call instead of the cash secured put. Get some cap gains and dividends in your account, guys. Sooner. Cut your losses. Cut and run. Hop into bed with a better looking person. It's okay with stocks, okay? And then the other thing is learn seasonality, okay? Get a better education around this. If you want more tips like this and you've never considered some of this, I'm here to help with my Millionaire Mentorship Program. If you click the link on the video below in the description, if you are ready, I want you to be ready. If you book a meeting, be ready to make bigger returns now. I welcome you to spend, 20 minutes with me and let's talk about how we can get you making better, more consistent money.